Assalamu alaikum friends, welcome to day 8 of AFM 14 days revision crash course. The topic that we are going to cover is option pricing. Now, do not confuse this option with the option that you are going to use for hedging risk management. That option is different, that's a financial option. This option is different, okay? This is called real options. And this option, you might get with the net present value, sometimes you might not get. It depends. So this question has a habit of appearing sometimes. Okay, I would not say it comes all the time, but when it comes with huge amount of marks with it. Okay, because it has lots of calculations, it has a formula to it, so you can easily score marks in this area if this ever comes in your exam. So here we are going to focus on the past exam history, real options in investment appraisal. Okay, but before the real option, first we need to understand how the options are priced, the principles of options, how it works, the value of the option, how do you value an option. The Black-Scholes option pricing model, which is the main theme of this uh, topic, option pricing, right? To price the option, you need to know the Black-Scholes option pricing model. There are 5 variables, you need to know all those 5 variables. It's just basically is like you just need to know the formula and just put the numbers in that and get the answer. The delta hedge. Okay, so in the past exam history, if you have seen, real options came twice. Okay, once in question 1 and one in question 2. So this means it can come in any question. Okay, it depends on which question does the net present value comes. Is it in question 1, 2 or 3? Because real options comes with net present value. Okay, separately it does not come, it comes with net present value only. So that means first you will be calculating your basic net present value like how you normally do, right? Cash inflows, deduct cash outflows, discount it, find net present value. After that, do the calculation by using Black-Scholes option pricing model for a real option and then add that value with the net present value to find the overall value of the investment. And then you decide whether you're going to invest in that investment or not. Finally, the delta or other Greeks. In your AFM syllabus, this time they have removed some Greeks. There are 5 Greeks. Okay, these 5 Greeks are exactly the same variables that are used in Black-Scholes option pricing model, which we are going to cover soon. Okay, same. But some of them are removed from AFM syllabus. So only the ones which are included, I will explain that. Earlier there were all the 5 Greeks, you need to know all the 5 Greeks. Now it's removed. So it's better, right? Now, first you need to understand what is an option. The option gives you a right. It's not an obligation. It gives you a right only to exercise. That means you can buy or you can sell a good at a exercise price. That means a price is set. That price is known as exercise price. Okay, at an exercise price at or before a specified date, at some future date, let's say. Okay, some future date is decided before that. At this date, no matter what happens to the market price, you are going to buy a product at this price which is set today or sell at this price which is set today in the future. That is an option. It's not an obligation. You always have the option not to exercise the option. You understanding? So that's why option is like a it's giving a choice. It's very flexible, it's giving a choice. Right, but not an obligation. It's not compulsorily that you have to exercise. No. If you don't want, if you feel it's not favorable, do not exercise the option. Okay. Option also has 2 types. There are 2 options which you need to know. One is known as call option. Remember, this option that we are studying here, principles, applies in your risk management also. There also you need to know. Why? Because you need to know what is call option and put option. So the definition is explained in this chapter. Later I'm not going to explain. When I go to risk management, I will expect you to know how option works. So basically we'll be using that for hedging only. I will not explain you what is an option. I will not explain you what is a call option. I will not explain you what is a put option. How option works now. So better you know it. You have to watch this video till the end to know options very clearly. Okay. 2 options, call and put. Call option means right to buy. Right to buy. And put option means right to sell. That's why I've highlighted the word call, buy, put, sell. Call, buy, put, sell. Okay, remember it like this. Because this option is like giving you a choice. Remember, choice also has a price to it. That's why option is expensive. That's why these options are expensive. It does not come free of cost. They are giving you that choice to exercise or not. You are taking that advantage, right? Because of that advantage that you are taking, you have to pay a price, and that price is known as premium. Premium, you have to pay a premium, and this premium needs to be paid upfront. The day you take the option, does not matter whether you have exercised it at the end or not. You have to pay the premium. Okay, so basically, premium is the cost of option. You understanding? So this that means whether you exercise or not, the maximum that you're going to lose from an option is that premium. That's your cost. That's your maximum cost. Beyond that, you will not lose premium. Okay. Now, what is this exercise and strike price? Exercise, another word for exercise is strike price. You need to know these terms. Okay. It depends on examiner whether they will use strike price or they will put exercise price. The meaning is same. It's like a fixed price for that option. Okay. There are two types of options. Style. Okay. One is known as European style. The other one is known as American style. European style option means you can only exercise at the expiry date. Let's say you're taking a 3-month option. From in Jan you're taking. It will expire in March. So you can only exercise that option on 31st March. But the difference with American style option is American style option you can exercise anytime up to the expiry. If you're taking a 3-month option from Jan, like you're taking it on Jan, expires it on March, Jan, Feb, March, right? You can exercise this option in Jan also, in Feb also, in March also, anytime until 31st March. That is the difference. Okay. So, and by the way, for your doubt, if you have this doubt, which option are we going to do in this question? In AFM, we are going to focus on European style. That means we assume we are going to exercise the option at the end of the expiry date. Okay. But even if an American option comes, we always use the Black-Scholes option pricing model only. Same for both. Why Black-Scholes option pricing model? Because Black-Scholes option pricing model is only used for European style option. But if American options are given, you can use for that also. But normally they will not give you American style option. It's always European style. Okay. Just to make things easier, simple. For the purpose of simplicity in exam, they are giving you this. The only model is Black-Scholes option pricing model. Whatever the option it is, American style or European style. Call or put. Okay. An option is purchased by the buyer from the option seller or writer. Remember, you buy this option from whom? The one who is selling that option. That one who is selling that option to you is known as option seller or option writer. Okay. Example. An investor holds an European style call option. Call option means option to buy. Okay. 2000 PQ shares at a strike price of 5.4. Expiry date 30th September. That means the holder has the right to buy 2000 PQ shares at on 30th September at price of 5.4. Okay, this is the meaning of this. Now, coming to option value. There are major factors that determines the price of a call option. If you see, some call options are very expensive, some are not so expensive. Why? Why that difference? Because there are some factors that determines that price. You need to know this factor. Number one factor. What is the price of the underlying instrument and the exercise price? See, if it's a call option, okay, please understand this. Nature of call option means option to buy, right? You definitely want to buy at a price which is lower, correct? So if your market price is lower than your exercise price, will you exercise the option? No, right? Because you want to buy it in the open market at lower price than your exercise price. So that means your call option is not of a valuable. It's not valuable because you will not exercise. Basically, you are comparing the price of the underlying instrument with the exercise price. That's how you decide. You understanding? Second, the time to go expiry. Greater the time, okay, till expiry. What do you think? What will be the value of the call option? At the end, I have a summary of this also, so don't worry. I've summarized this also. I think it was in my lecture or in this one, I don't remember, but there's a summary of this. Greater the time, greater the value of the call option. The volatility. Basically, these are the 5 variables that I've been talking about. Volatility means standard deviation. Greater the volatility, greater the value of the call option. Interest rate. Interest rate. This also matters. Okay. And risk-free rate. Now, let's understand another term that is known as intrinsic value. What is intrinsic value? Intrinsic value means you compare your exercise price with the underlying asset. That is the meaning of intrinsic value. Underlying minus exercise price. Okay. How do you tell when your option is favorable or not? If your exercise price, okay, is less for a call option. If it's a call option, exercise price has to be less than your underlying price. Then only that option will be favorable. And it is said as the option is in the money. In the money. That means it's most favorable. Okay. That means your exercise price is now more favorable. Why they say favorable? Because it depends. If it's a call option, having lower exercise price is good. If it's a put option, having higher exercise price is good because you have to sell. That's why. Whichever you are choosing, you choose whether that exercise price is favorable to you or not. If it's more favorable than the current market price, option is in the money. If it's if it's the other way around, exercise price is not favorable, then the option is out of the money. That means intrinsic value is 0. It can never be negative. I have already told you underlying minus exercise price, underlying minus exercise price, underlying minus exercise price. It cannot be negative. If it's negative, the value is 0 only. That's why intrinsic value is 0. And if it's 0, out of the money, exercise price is not favorable. Why will you exercise the option? Option is not exercised. Okay. Third situation where both are same. Exercise price is same as current market price. This is known as at the money. Okay. So will you exercise or not? It's your choice. But if you ask me this question, I would suggest not to exercise. Why? Because simply why to pay that premium? That premium you will waste, right? It's just the same. Whether you buy it from here or there, whether you exercise the option or buy it from the open market, it's not much of a difference because price is same. Rather, if you exercise the option, you have to pay the premium also. So I think it's a waste. So we don't exercise. Okay. Now, on the expiry date, remember your option will be equal to its intrinsic value. Why? Why? Because option also has a time value. Remember, greater the time, greater the value of the option, because you have more time to think whether you are going to exercise the option or not. You are more likely to exercise the option if you are given a longer time. So option has a value, time value also. Time value also, intrinsic value also. But when the expiry date is over, you have reached the expiry date. Where is that time remaining? No time, right? That's why it is only intrinsic value at that time, no time value. So the value of the option is equal to its intrinsic value. Now coming to the Black-Scholes option pricing model. I've covered all this in detail in my lecture. You have to go to my playlist, okay, the AFM lecture. There you will get the detailed explanation, because as I told you, this is just a revision crash course. So before you come to this, you have to finish with the lecture. I'm assuming you know all this. What is this Black-Scholes option pricing model? Everything. This is a very popular exam question. In the past, it has been asked many times. Now it has been little reduced, but you might get any time. Be prepared. Okay, you need to know these things. Before you apply this in the model, understand what it means. PA, what is this PA? PA is the price of the underlying instrument. That means your current share price. What is PE? Sorry, NDI or ND1. the probability that a normal distribution, you have to use a normal distribution table for this, by the way. Normal distribution table is less than DI standard deviation above the mean. You don't have to understand this meaning. Don't memorize. I will show you how to do it. PE, the exercise price, okay, which will be given. R, risk-free interest rate, will be given to you. But remember, they will give you in terms of percentage, 30%, 40%, 5%, 2%. You have to use it as a decimal number. Okay. If they say, let's say, risk-free interest rate is, let's say, 7%, it will be 0.07 as a decimal number. You have to use it as a decimal number only. Then T, time to expiry. This also decimal. How? Let's say it's a 6-month option. 6 divided by 12, 0.5. If it's a 3-month option, 3 divided by 12, 1/4. That means 0.25. You have to use it as a decimal. Time to expiry also. Okay. So you have your PA, current share price, exercise price, standard deviation, risk-free rate, and time. All the 5. Now, sorry, S, standard deviation. Sometimes they give you standard deviation, sometimes they say volatility. Sometimes they tell variance also. Please understand, if they tell volatility or standard deviation is the same thing. Okay, no adjustment to it. Just use the figure as it is. But if they give you variance, okay, if they give you variance, you have to find the square root of that variance, because you cannot use variance in your equation, because in your formula standard deviation is there. So what you have to do, if variance is given, square root of that variance is standard deviation. Okay. Now, basic form. The basic form means this formula, through this formula you can value an European call option. This is for call option only. For put option we have a different formula. Okay, this is the formula. That's why you can see C, because it's only for call option. Remember this. First you need to know for call, then for put, because without understanding call you will not understand put. I will tell you later why, because there's a relationship which is known as call put parity. Understand this very clearly. So you can see the formula. Formula is there in your exam sheet. Okay, you don't have to memorize it. It anyway will be memorized if you are doing lots of questions on this. Okay, with this formula automatically it will be there. You will know what to do. So first we'll take one variable at a time. PA is what? Underlying price, share price given to you, correct? Multiply by ND1. ND1 also you know. You have to see my option pricing option lecture for that. I've done questions there. Then minus PE. PE is your exercise price into ND2. ND2 separately you have to find out. ND2 can be found only after finding ND1. Okay, understand this. Then finally multiply by e to the power minus RT. E is E only. Okay, in your calculator, minus R to the power T. R stands for risk-free rate into time T. Okay. D1. Please see how you find D1. This is how you find D1. PA will be given, PE will be given, ND1, ND2 you have to find out. Okay. D1 is ln. Ln means it's not in, it's ln, logarithm. It's a logarithm function. Okay. Remember logarithm function in maths? Same you have to use in calculator. Okay. You have a calculator in your CV platform. You have to make use of that calculator. Log function will be there. Log. Okay. Or ln. It's the same thing. So logarithm of, put bracket, PA, underlying price divided by exercise price, plus R, that is your risk-free rate, plus 0.5. This 0.5 is fixed. Okay, it's there. So 0.5 into S squared. S is your standard deviation. That means multiply by standard deviation squared times T. At the end times T, closing the bracket. Divide by square root standard deviation multiplied by square root of time. Okay. Then comes D2. I told you why D2 is relevant on D1, because D1 minus square root of T. You understood? Square root multiplied by T. Sorry, standard deviation multiplied by square root of T. Once you find D1 and D2, then you have to use normal distribution table to find ND1 and ND2. Okay. Next, calculation I'm not showing here. I've already done it in lecture. Revision kit questions, solutions which I have solved. Enough of questions. I've done it. You can go there and see. My playlist is there on AFM revision solutions, revision kit solution, and also my AFM lecture. Okay. So Black-Scholes model is used to price call options. I told you, right? But because there's a relationship between call and put, through that call you can find put also. But you still have to derive uh, with the value of a call option. You have to find C first to find P. That means no matter whether you get put option or not, at least you have to know, you should be able to find C, because only after that you can proceed to find P. Okay. So if you have a put option, that's like an additional thing that you have to do after finding call. You cannot say I have put option so I don't have to find the value of call option directly to put option. No, you cannot jump like that. It has stages. You have to follow that, because this is a formula for put. This is also there in your exam sheet, which is C. C is your call option that you have just found out, minus PA, your underlying price, plus PE, exercise price, into E to the power minus RT. Okay, this is the value of the put option. So just one more additional step you need to do if you have a put option. Now, the hardest thing in your exam, if you are given an option, there are 4 types of option, by the way, real options. Out of this 4, you will be given one, and you have to decide, you have to know whether it's a call and a put option. Examiner will not tell you it's a call option or a put option. They will tell you it's an option to delay, option to expand, option to abandon, option to switch. They will only tell you that. You have to know whether it's a call option or a put option. Accordingly, you will find the value. If it's a put option, you have to use this formula. If it's a call option, stop till call. Okay, and add it with your net present value. And then you have to interpret like how you normally do. Like you have to write. Calculation is not enough. You have to write also after that what. What do you do? Like, are you going to invest in the project or not? That's the whole purpose of giving you this real option. Now we are coming to the theory part, discussion part. Remember, Black-Scholes option pricing model is not just calculation. You will be given discussion also. So what are the limitations of this model? The limitation of this model you have to know. You have to know it. It assumes no dividends are paid in the period of an option. Okay. Because we are talking about share price, right? So we assume that in that share price there is no dividend, because if you pay dividend, share price will get affected, right? Isn't it? But we assume we are not paying any dividend. That's why we find an exercise price and keep it, and we know it's the same, because we assume no dividends are paid during that period of option. Then second limitation only applies to European call option. But if the above assumptions held true, you can use it for US options also, American options also, American call options only. Third, risk-free rate, it is assumed that it's known, you already know it, and it's constant. It's going to remain the same throughout the options life. But you know, in reality, it's not easy. You might not know it, it does not remain constant. Fourth, as a limitation, standard deviation is constant and you know it. But in reality, you actually don't know the volatility, right? And it's not even constant. But for the simplicity of this model, you assume all this. Fifth, and the last limitation, we assume there are no transaction costs, there are no tax effect when you're buying or selling the option. Okay. Now, if because we assume dividends are not paid, what if dividends are paid before that expiry? So if dividends are paid before expiry, you need to calculate a dividend adjusted share price. You have to adjust it with dividend. Okay. How do you do? Simply deduct the present value of dividends to be paid from the current share price. That's it. Normally what you do, you deduct dividend from share price. No? Here, do the same thing. Find the present value of dividend and deduct it from current share price before the expiry of the option. Second, so this is how it becomes. Your PA will then become PA minus present value of dividend in the Black-Scholes formula. Then Note that in your computer-based examination, you should use the separate calculator, BSOP calculator. You will see that is there. Black-Scholes option pricing model calculator is there. Okay, when you're performing Black-Scholes model calculation. So if you enter the 5 key input variables, your spreadsheet, good thing is it will automatically calculate the result, but you should know how to do it. Okay, you should know how to work with this calculator. So please do it. Do that. Okay, don't just study too much of lectures or memorize too much from textbook, or just don't keep questions randomly new questions only all the time. Do these things also. Practice. You should have a hand on your CBE platform. All the tools, all the formulas. You should know where it is at what place, because this saves a lot of time. Don't go with this assumption that in the exam you will figure it out. You can't. It's an additional extra wastage of time. If you're not prepared with all this, you should know what tools are at what place. If I want to highlight, where is the highlighter? If I have to cut, copy, paste, how do I do that? All these things should be done while you are practicing. That's why when you do questions, any question, now in ACC all are CBA, not any more paper based. You have to do it in spreadsheet and Word, Excel. Sorry, in Word processor. Okay, you have to do it on a CBA platform rather than doing it manually and then shifting it to CBA. Because later, if you are planning to shift it to CBA, it will take a lot of time. Number one, to get adjusted. Second, because you're short of time now, you'll be panicking, you'll be not doing so many things, you'll be missing out on the important things. So my humble request is, from day one only, practice on a CB platform. I know it will be a little difficult, you will not like it, but you have to get adjusted to it. That's your real environment. Get yourself adjusted to that real environment, pressurize yourself as early as possible. Okay, don't be too late to, to come onto the CB platform. It takes a lot of time. Like how it takes to take time for you to understand any new concept, same way on a CB platform also there are so many things you have to learn. It takes time. Okay, so please do that. Now coming to the delta hedge, very rare it comes. I think 1 or 2 eyes it came, and usually it's not for so many marks, 5 or 6 marks. But as I always say, don't even lose 1 mark, because students fail at 49. So you know the importance of 1 mark in ACC, isn't it? You cannot lose even 1 mark also. So delta hedge, the formula is, delta means how much the value of your option changes because of the changes in other variables. You know that option value is dependent on 5 variables, right? Standard deviation, time, risk-free rate, exercise price, and all those things. But what if they change? They are also based on some assumptions. What if they change? Standard deviation change. Value of an option also will change, right? So how much that change? That is known as delta. And delta measures that change. So the formula is changing the price of the option divided by changing the price of the underlying security. Okay. Now basically you use this. The question might ask you how many call options to sell. Okay. So the number of call options to sell. Okay. This is how you do. Formula is number of shares held divided by ND1. ND1 you must have already calculated before. That only. If it's number of shares to hold, then it will be number of call options sold into ND1. Okay. Now, real options in investment appraisal. What does real option do? It's like they're giving a flexibility. See, when you're calculating net present value, what do? You base your decisions only on that one figure. If it's positive net present value, you accept the project. If it's negative, you reject the project. But it's just one figure. And it does not even give a value for flexibility, because it is assumed only you will go ahead with the project. Correct. 4 years project, you go ahead with the project. This is the cash inflow. This is your net present value. What if due to some circumstances you cannot go ahead with the project? Maybe you are delaying the project. Maybe the project you are abandoning the project in between. Maybe you are switching the project to something else. Right? Could be anything. Net present value limitation is it does not value that flexibility, but real option gives you that opportunity, because in real life you have flexibility, isn't it? You can expand later on, you can delay, you can switch, you can abandon it. So real options, they value this flexibility. That's what real options do. That's why we are using Black-Scholes option pricing model to value the option. Second, they are options on real physical asset. Okay. Remember, I told you from before only when I started this that this option and the financial options that you use to value your to hedge your currency risk and interest rate risk are different. This is for real physical asset that you are having an option. Okay, so value of this option should be added to your net present value. So this is how it goes: net present value plus value of real option. Okay, Black-Scholes option pricing model should be used in an exam to value this option. Anytime real option is given, Black-Scholes option pricing model. Okay, for a real option, if it's a real option, PE. Okay, what is PE? Capital investment required. How much capital do you invest? Do you require to expand the project, or to delay the project, or to abandon the project, or to switch it to the other users? That is PE. And if it's PA, remember everything remains the same: time, standard deviation, and risk-free rate. The only changes are in two places: PA and PE when it's a real option. PE is for capital investment required. PA is present value of the future cash flow, because here you will not get the share price and all those things for real option, right? Present value of future cash flow. Let's say if you want to delay a project, or let's say if you want to expand after 2 years, what is the present value of that future cash flow? That is PA. Okay, be very careful what are you using in PA and PE for a real option. Okay, that's the only difference. For further reading, there are two articles, technical articles on your ACCA website on real options. They have questions, they have worked it out, solved it for you. Please go and check it. So for this video, that's it. Thank you for watching, and the next is the most important topic and my favorite as well as yours favorite. I know that. Okay, I can understand from the reactions, and also most of the people do well also in this part. That is risk management. Okay, section E of your AFM syllabus. So we are over with investment appraisal. We are moving on to risk management. We are managing two types of risk: currency risk and interest rate risk. Okay, thank you for watching, and do not forget to subscribe to my channel if you haven't. Share this content with your friends as much as you can. Okay, make sure everyone is aware. And by the way, a good news that I want to share with you today is that I have reached 6k subscribers, 6,000 subscribers, and thank you all for the 6,000 subscribers. It's a big thing for me. It shows how much you people are actually watching my content and how my videos are actually helping you in your preparation of your exam. So I want as many ACCA students to reach to this channel as possible. Only you can make it possible, right? I might not be able to reach to everyone, but through you, I can reach many students. So please help me in this process, okay, to reach out to many people as possible. And thank you for watching, and see you in the next video.